Okay, so something really weird just happened in the market. One minute, AI is the king of the world, stocks are rocketing to the moon. The next, it's a total bloodbath. All those high-flying tech stocks are in a nosedive, and the strangest thing is happening. The most boring, predictable stocks are suddenly the only things going up. Seriously, what on earth is going on?
I mean, look at this. The market is literally being split right down the middle. On one side, you've got the AI titans, right? Your NVIDIAs, your Palantirs, just getting absolutely steamrolled. We're talking hundreds of billions in value, gone, just like that. But then on the other side, utilities, consumer staples, the stuff that's supposed to be slow and steady. Well, they're climbing. It's a complete role reversal. It's like the world turned upside down overnight.
And that really brings us to the core question of this whole explainer. What could possibly trigger such a violent and, frankly, counterintuitive shift in the market? What kind of force is powerful enough to make investors run screaming from the biggest Wall Street story in years?
Now, what makes this so fascinating is what didn't cause it. It wasn't the Fed suddenly hiking rates. It wasn't some shocking inflation report that came out of nowhere. There was no new international crisis. All the usual suspects, they have alibis. The real trigger, it turns out, came from somewhere nobody was looking.
That's right. The thing that vaporized billions in market cap wasn't a warning from a big bank or an attack from a short seller. It was a research paper. A paper from one of the most respected universities on the planet, MIT. An academic report just sent shockwaves through the entire financial world.
So let's get right into it. Let's talk about this report. Because hidden inside all the academic language was one key finding that acted like a fire alarm in a packed theater. And it all boils down to one single, absolutely devastating number.
You know, the researchers at MIT, they did their homework. They interviewed 150 executives at major U.S. companies, they surveyed 350 frontline employees, and they went through 300 public AI case studies. And what they found was a truth that Wall Street had been, let's say, conveniently ignoring.
95%. Just let that number hang there for a second. It's huge. So what does it represent? Well, it basically represents the single biggest fear every investor had about this whole AI boom.
Here it is. This is the bombshell conclusion from the report. A staggering 95% of companies that are pouring money into generative AI have failed to get any financial return on that investment. Not a small return, any return. We're not talking 50%, not 70%, 95%. For almost every company out there, all that money, all that hype, it's just been a giant black hole for cash.
But here's the really crucial part of the report. The problem isn't the AI itself. The technology works. The models are powerful. The issue is how these companies are using it. This is a failure of corporate strategy, not a failure of technology.
And the report found this huge divide in how companies are approaching this. That tiny 5% that's actually succeeding? They're laser-focused on specific problems, like automating boring back-end processes. They buy tools that are already proven and, this is key, they let the people on the front lines, the ones who actually know the business, lead the charge. The other 95%? They're chasing hype, trying to build these massive, complex systems from scratch, and they keep their AI experts locked away in some central lab, totally disconnected from the real world.
At the end of the day, you can trace this failure back to one simple thing: a massive misallocation of cash and resources. Companies are just throwing their money at all the wrong problems. Just look at where the budgets are going. It's kind of insane. More than half the money is being spent on sales and marketing hype. You know, generating ad copy, writing social media posts, making slick-looking presentations. This stuff looks cool, but it has almost zero measurable impact on profit. Meanwhile, the one area with the highest potential ROI, automating all those clunky back-end processes, it gets just a tiny sliver of the budget.
Now, let's be clear. This MIT report didn't just create this crisis out of thin air. It was the spark, for sure. But the market was already a tinderbox, completely soaked in hype and stretched to its absolute breaking point.
And then, just pouring gasoline on that spark, you get this warning just days before the report even came out. Sam Altman, the CEO of OpenAI, the face of the entire AI revolution, he goes on record saying the excitement is overdone and that some investors are about to get burned. So you have the academics saying it's not profitable, and the industry's #1 insider saying a correction is coming. For the market, that was a devastating 1-2 punch.
And all of this was happening when valuations were already in the stratosphere. Just for context, your average S&P 500 company trades at around 21 times its earnings.
Microsoft was trading at 35 times earnings, and Nvidia was pushing 40. I mean, investors had priced in not just years, but decades of absolute perfection. That leaves zero room for error, and definitely no room for a report that says 95% of the spending is worthless.
So you can see how it was a perfect storm, right? First, you get the hard data from MIT that just shatters the whole profitability story. Then, the ultimate insider basically confirms everyone's deepest fears. And with those two hits, those sky-high valuations became totally impossible to defend. The bubble of just believing in AI, no questions asked, it had just been popped.
So, this big sell-off was more than just a drop in prices. It signals a fundamental change in what the market actually cares about. We are watching a sea change in investor psychology play out in real time.
And the bottom line is really simple. Investors are just tired of hearing stories about some amazing future that might happen 10 years from now. They are demanding something much more real, something tangible, and something right now. Actual cash flow and actual profits. The age of betting on a dream is making way for a search for certainty. So in this new world, how should investors even think about adapting? Well, the source material suggests a 4-part strategy. First, start by diversifying away from those super concentrated, high-priced AI giants. Second, maybe add some of those boring but really stable sectors that generate real cash. Third, go hunting for value in smaller companies that got left behind in the AI frenzy. And finally, of course, stay flexible. The environment is shifting, and a balanced approach is everything.
And that leaves us with the big question, doesn't it? Was this whole sell-off just a temporary panic, a healthy little correction in a sector that got way too hot, or are we actually witnessing the beginning of the end for the great AI bubble? The story is shifting from hype to reality, and only time is going to tell who the real winners will be.